Hello, and thank you for joining us today. My name is Jennifer Heward, and I'm a bilingual senior client success specialist with Snap Projections. Today, we will demonstrate how to add a spouse to a projection. If you have any questions during the presentation, you can click on Q&A at the bottom of your screen, type in your question, and I'll do my best to answer you during the session. And if not, if time does not permit, I will respond by email following today's Q&A. So we'll start by adding our new primary client, and then we'll add a spouse and provide some helpful tips and tricks relating to that. So today's client is John Snapper, and his date of birth is 1974, 09, 12, and he resides in Ontario. So we've compiled our client's information in the financial planning questionnaire that I'm about to show you. So this is our client questionnaire, and this is very helpful because you're compiling the information in the order that you're going to be inputting it into Snap. And so you can find this on our help site. So if you go to your top right, click on Help, and then click on Help Center, and you go into Start Here. You'll find our financial planning questionnaire. And then you can download that. We have two versions, a short as well as a long version. And it's also available in French if you have any French speaking clients and if you speak French yourself. So you can actually fill this out, or you can have your clients fill this out, or you can fill it out with their help. Now, some of the things that you might ask your clients to bring to their initial appointment that would assist you in completing this questionnaire would be their recent financial statements, recent T1 generals, recent notice of assessments, recent pension plan statements, recent insurance policy statements, if any, recent corporate financial statements, if any, and anything else they deem appropriate. Now, on our help site, you can reach us either by clicking on contact to send us an email, or you can always give us a call. Our phone number is listed there. And we have a variety of articles and webinars available to assist you in anything you're trying to do within the software. And you can also search for various topics as well. All right. So, and a new thing that I should mention that we have as part of our help link is we have AI answers that will provide information from our articles. So please note that this does not have any access to your projections, but if you are searching for something, it will search our knowledge base resources and provide you with those answers that way. All right, so we can see now that SNAP is comprised of three sections or three steps, you might say. We've got the scenario set up. Once the basic client information has been inputted, we move on to our planning pages, and then from there, we can generate client reports. So we're going to continue on in our scenario setup, and you can see that there are various sections to this, and we can move through these by clicking on them in our left navigation menu, or we can click Next to get to the next page. So this brings us to our general page, and because we are near the end of the year, we are going to start our projection in 2026. And then the retirement age for our client is age 65, and we're going to show this projection until age 100. Throughout the application, you will see lots of question marks. So if you put your mouse on a question mark beside any term, it will give you more information to explain what it is that it's referring to or what we're looking for what you might have to enter there. All right. Now, our inflation rates and our rates of return are based on the FP Canada guidelines. You can edit these. We'll leave the inflation rates the same. However, we will update our rates of return to provide for portfolio management fees. So for cash, we're going to use 1%. Fixed income, we'll use 2.5. And for equity, we'll use 5.5%. Now, if ever you wanted to return to the guidelines, you can just click on Use Guidelines up here. But let's say you want to save these rates of return. We can go to Defaults here at the bottom, and we can save these current page settings for all new scenarios. All right. So now we'll move on to the expenses page. And we're going to set the base expenses for John to $48,000 a year, I should say. And just so you know that these would account for groceries, outings, transportation, property tax, things like that, but would exclude any other expenses that are provided elsewhere in the software. So, for example, we'll be putting information relating to the debt repayments elsewhere, as well as we could also be including insurance premiums for any insurance policies they might have. So those amounts would not be included as part of our base expenses. And again, that's because they're provided for elsewhere in the software. We can also add additional expenses should we wish to. And so that would be for things like vacations or possibly a home renovation in the future. We can set that for the future if we like, and we can also add a frequency to that. So we're going to delete that for now. And then we'll move on to our incomes page. And so here we have employment income for John of $100,000 per year. We're going to index that to general inflation. And the way we can do that is we can just click on our backspace key and then general inflation pops up. So that's an employment income. It is taxable and RSP eligible. And that is going to run until his age 64 because he's retiring at age 65. However, if you put your mouse in that field, you could click on the gear icon and you could specify the actual retirement date. And then the system will prorate that income in that final year. Okay. If he did have a defined benefit pension plan, we could add that here, but we'll be showing that later on once we get to the spouse. So we're going to move along here now. All right, so then we're moving on to the assets page. Now, I always recommend that we delete the default non-registered account. We're going to set up our own with our own information relating to that account. So let's start with an RRSP with a value of 185,000. The type is RSP, so you can either type in an R in there, or you could select from the drop-down menu, the RRSP RIF. And that's going to have an asset allocation of 0% cash, 40% fixed income, and 60% equity. And you'll see that our rates of return for each asset class is drawn from what we entered in our general page. And then we have the total rate of return based on that asset allocation here. All right. Now we'll add the tax-free savings account worth 100,000. That's a TFSA, same asset allocation. And then we will add the client's non-registered account. And that has a value of 18,000. And the minute we indicate that this is a non-registered account, it's going to ask us for the cost. So our book value on that plan. But because we have 100% in cash, we'll leave the cost at 18,000 for now. So then we have other tabs here. So we have the TFSA tab where we could update the client's TFSA contribution room. So let's say they have not been contributing the maximum since the beginning of the tax-free savings accounts. We could increase that here. Same applies here for the RSP contribution limit. So what we're going to do is we'll update his contribution room as per his notice of assessment to $37,400. If he had a defined benefit pension plan, we could add his pension adjustment here. And then we can also change the RSP conversion age if we wanted to here from the default of age 71, where it is mandatory. So there are other tabs up along the top here, but they don't apply to this scenario. So we'll save those for another day. So we're going to go back now and we're going to add a real asset. So we are going to add the family home, which is worth $600,000. The cost is irrelevant because it's the primary residence. And there's no future purchase age, but let's say our client was downsizing in the future, we could add a future purchase age for a downsized home. And then if we knew that our client was going to sell this home in the future, we could also indicate a future sale age. And then the capital gains tax is no for the principal residence. All right. So now we'll move on to the debts page and we can add a mortgage with a balance of $90,000 at an interest rate of 5%. This will be interest and principal with a monthly repayment of $900 a month. It's not tax deductible, but we are, however, going to link this mortgage to the real asset, which is the home. The reason why we do this is that if in the projection we decide to sell the home, the proceeds from that sale will pay off any remaining balance owing on the mortgage before being used for other things, such as possibly investments. So then from there, we can move on to our government benefits page. And so SNAP by default is going to have the CPP starting at age 65 when the client retires. By default, we use 57% as the national average for the percentage of maximum that a client would receive. But we know that Justin would have contributed enough to receive 90% of that maximum. And so as soon as I click outside of that cell, you can see that the annual retirement benefit increases. So you can either add the percentage, or if the client has provided you with their CPP statement and you know the amount, you can enter the amount there as well. And then for OAS, I should say, that will start at 65 with 100% of the benefit. So you can also prorate these amounts. So let's say the client's date of birth is in June, and in the first year, they're going to start receiving their government benefits as of, let's say, July 1st. By prorating this, we will see half of a year of those benefits in the plan for that very first year that they're receiving them. So I'm just going to open up the Q&A here just to see if there are any questions to date. And no, I do not see any. So we will just continue along. So now that we've got our primary client set up, we can now add a spouse. So we can go here beside John's name and click on Add Spouse. So our spouse's name is Julie Snapper. And she is a little bit younger. So she's born in 1976. Date of birth is November 11th. All right. And so if we move on to the general page now, we can actually see that SNAP has her retiring in the same year as John, and her projection also ends in the same year as John. Okay, so this is the most simple solution where we don't need to be concerned with any transfer of assets. So now we're going to move on to the expenses. Now we had originally indicated 48,000 for John, 48,000, yes, for John as an individual for base expenses. But now that there's two of them, we're going to add the combined annual base expense amount of $96,000 a year. And we're also going to add travel. So that'll be an additional expense in the amount of $10,000 a year. We're going to make this joint. All right. And then this is going to run from the current age to Julie's age 73, and that the frequency will be every year. And what we're going to do is we're going to say highlight yes. So that will highlight this travel expense in the legend of our cash outflow chart, which we'll show you later on. So I guess I should let you know that, we are on Julie's page. Okay. We have a tab for John and a tab for Julie. And we can also tell that we're on Julie's page because her name is in the page heading. Okay. So moving on now, we can go to her income page. And she has an annual income of $80,000 a year. We're going to index that to general inflation by hitting our backspace key. And that is taxable and RSP eligible. And that is also going to run till her age 62 because she's retiring at age 63. Now, Julie has a defined benefit pension plan. So we're going to add that. And this is going to start at her age 63. So now we have a section here for before age 65. So before age 65, she is going to be receiving $45,000 a year. That's got a survivor rate of 80%, and that is indexed at 2%. But from the age of 65 on, the amount she's going to receive is going to drop to $38,000, and that's because the bridge benefit will have ended. All right. So now we're going to move on to the assets page, and here we can take a shortcut. So because Julie has similar assets to John, we can go to John's page, and we have an actions column here, and we can copy the assets over to Julie's page. So we're going to copy over the RSP, and we're going to copy over the tax-free savings account, and we'll update those once we get onto Julie's page. We will make the non-registered account joint, and we will also make the home joint. All right. So now once we move to Julie's page, we will again delete the default non-registered account because we have our own with our own personalized settings. And then we can update her plans. So we know that her RRSP is worth $100,000. And because we now have a spouse in the projection, we can technically add spousal RSPs or RIFs to the plan. Okay, but this one is just going to be a regular. And we can see that that joint account is also listed there. So we can go to her TFSA tab up here, and we could update her contribution limit if we needed to. We could also go to the RSP RIF tab. We could update her RSP contribution limit. We will add a pension adjustment based on that defined benefit pension plan of $8,000. We can also elect to base the minimum RIF withdrawals on the age of the younger spouse. But in this case, Julie is the younger spouse, so we will leave that as is for now. So moving on to the debts tab, we can see that the debt has become joint, and that's because we've linked it to the home, which we previously made joint on the assets page. And then moving on to the government benefits, by default, SNAP is showing Julie receiving her CPP at age 63, which is her retirement age, but we're going to have her begin that at age 65. And we're going to assume that she'll be receiving the national average of 57%. Also, I would like to point out that we have We can illustrate the survivor's pension so that if Julie passes away before John in the projection, we will see that survivor's pension in the plan. So now that we're done with the spouse, I'm going to go to the Q&A and just see if we have any questions. So far, no questions. So everything is looking good and pretty straightforward. So now we can move on to our planning page. And this is where our clients' lives come together on one page. So at first, when you look at this page, you might feel a little intimidated. But honestly, it's very user friendly, it's intuitive, it's easy to navigate, and it's modifiable if need be as well. So you'll see that we have a combined page, we have a page for John and a page for Julie. And we can toggle between any one of these pages at any time. So we're going to start by going to John's page. And I can tell you that any numbers that are in blue or are in purple can be editable, okay, can be edited. So what we're going to do is we're going to start with our financial assets section. And you can put your mouse on a number. So for example, I'm on in the first year of the tax-free savings under the contribution column, and it'll tell you what his contribution room is. So we can see that he has a limit of 7,000. Same thing with the RSP. I can put my mouse there and we can see what his contribution limit is as of that first year. And we can do that in any given year. So we're going to make his contributions to his financial assets. We'll start with the RSP. He's going to contribute $3,000 a year, and we're going to copy that down to age 64, the last year he's working. And we'll click on that check mark. And then we will contribute $6,000 to his TFSA, also down to age 64. And then we'll run the scenario to update those changes. And then you will notice that these numbers that we have inputted are highlighted in yellow. So that's how you know what you have modified versus what Snap has come up with in the software. All right. Now, if you wanted to erase these, you could click on the X's and then run your scenario again, or you could click on the first one. You can select clear the override, copy to 64, and then select that, and then run your scenario again. But for now, I'm just going to X that out. And so now we'll go to Julie's page and we'll make her contributions as well. So she's got $3,000 going to her RSP to age 62. And she's got $7,000 a year going to her TFSA, also copied down to age 62, and we'll run that scenario to update the plan with our changes. So we see those there. And another thing we can see on this page, now that we have a spouse, is we can see that once she has a pension that can be split, we have a new transfers column showing the amount of the pension income that is split with John. So this reduces her taxable income. And if we move over to John's page, we'll now see that this amount is added to his taxable income. Okay. And we can also see the amount of the base expenses of the 96,000 that's been allocated to each of the spouses. Okay. So this is John's portion of the 96,000. All right. And if we go to the combined page, we'll see the full 96,000. And we'll also see what that amount translates to in nominal dollars, meaning that it has been adjusted to inflation over time. So before retirement, you'll see that the numbers are grayed out and they are in italics. All right. So what SNAP does is it's going to take the employment income less the deductions and the taxes, less any contributions to financial assets, and less any debt repayments. And then what it does is it takes the amount left over and assumes that that is what the client's spending amount is for the year. All right. Now, another thing I can show you is that under financial assets, we have all types. And if we scroll down to the bottom of the projection, we can see exactly how much is left over in their financial assets at the end of the plan, which is $478,000. And if we scroll to the far right, under the balances columns, we have a column for estate before tax. So you can actually click on that link, or you can go to the blue box, the menu box at the top. Both of those will give you the summary table for the last year of the projection. And so we have the totals here for the couple as of the end of the projection. And we also have the individual totals for them. So another thing I should point out is that if you ended the projection for one of the spouses before the other, you would refer to the spouse with the longest life expectancy in this chart to obtain the final values of the estate for the last year of the projection. All right. So now moving on to the combined page again and going over to the additional expenses, we can see the client's additional travel expense. And then if we go to charts, we will see that travel expense highlighted as part of the legend. And then we can see that it is ending in the year that Julie is age 73. Okay. And then we can go back to the combined planning page, and we can expand certain sections. So for example, in the income section, we can expand it, and then we can see the employment income by putting our mouse on the header. And we can see the employment income for John and the employment income for Julie. And then if we collapse that, we'll see the combined employment income. All right. This is also helpful in the income tax section. So we can expand the section, and then we can get additional information for their total tax and taxable income. And then under financial assets, we can see, for example, the non-registered assets, the registered assets for John, the registered assets for Julie. Okay. And then if we collapse it, we have the combined total for registered assets, TFSA, and then the joint non-registered account. So now moving on to the client report, and I'm just going to try to wrap this up quickly here because we're getting close to the end of time. You will see that because we have a spouse, certain pages, okay, we'll have, so for example, the cash inflow details, that would be a joint page that includes the information for John and Julie, but then they will each have their individual pages. So we have a cash inflow detail report for John and another for Julie. If we want to omit those, because maybe our clients aren't that analytical and they possibly don't require that much detail, you can find them here under the report builder. Okay, and you can take those individual pages out by sliding them outside of the table, of the included pages table. Okay, so all you have to do is slide them out. Now, another way you can do this is disable your included pages. And then once you go to your report editor, you can select or deselect any pages from the left-hand menu. So for cash flow projection, for example, this is the combined for John and Julie, but let's say I want to omit the cash flow projection for John, I would just deselect that. Same with Julie's, I could deselect that. And then you could return to your report builder, enable the included pages, and then you can just reorder your pages by dragging and dropping. All right. So that's about it. That concludes everything you could possibly need to know for adding a spouse. I'm just going to check the Q&A to see if any questions have come in, and none have come in. So I guess we are at time here. So if anything comes up, you can always send us an email through our help site, and I will be happy to get back to you with any questions that relate to today's presentation. Thank you for listening, and best of luck with SNAP.